Welcome to our financial future. This is a channel designed to build a community of investors so we can all reach our financial freedom. In this video, I'm going to go over growth stocks. I'm also going to dip into the emotions we are going to experience while investing in these companies, the types of financial things we should be looking at, how these companies are disruptors, or are they the one disrupting you? We're also going to go over a metric Warren Buffett likes to use, and I'm going to explain why I don't like to use certain ratios when it comes to growth stocks. And at the end of the video, there's going to be a tip on how to greatly improve your watch list. So let's get into this. We all want to go into the stock market and get those big returns. Growth stocks are the types of stocks that keep the stock market fluctuating, and this is something that can play with our emotions. We all want to get those returns, but we know with the more returns we try and get, the bigger the risk we have to take. The market is always going to be fluctuating on the upside and downside, and this is going to play into our investing strategy. Stock market analysts can be very hard on these companies, and this can be very hard for an investor to watch this happen to one of their growth companies. But if you are on the other end, you are in a very good spot that can be very exciting with the decision you have made. These types of stocks can be emotional roller coasters. One day you can be down 30% wondering why you ever invested in the stock, and the next day you can be up 40% thinking you're the best investor ever. These stocks will test your emotions. It's something that you're going to have to master as an investor to not let these companies impact your emotional intelligence. There is a psychology term used called loss aversion, and how this plays into investing and growth stocks especially is that you don't see the reward from the risk, and the risk actually scares you from the potential reward that you're gonna get. So when stocks like growth stocks fluctuate so much, they can actually scare you when you see the potential loss compared to the potential gains. And this could stop you from investing. And what you want to get good at is creating your story so that loss aversion doesn't affect you and you have confidence to buy those shares. The only way to become a better investor is by doing the research, because this loss aversion won't affect you because your confidence will be so high because of the research you've done that you won't be scared of losing money. So if a stock did drop 20%, you are still trusting the story that you built and are confident that that stock is going to go up. When we first decide that we want to add risk to our portfolio by purchasing a growth stock, we really have to see the sector that it is in. We could be possibly self-sabotaging ourselves if we go into a sector that is already failing, because it doesn't matter how well that stock is doing in that sector. If the sector is falling, all those stocks and companies will bring it down with it. For example, you might be in the furniture industry and you have the best chair on the market. Unfortunately, furniture isn't a growing industry, so those stocks that are failing are going to bring down the industry as a whole. But if you take a look at the streaming industry with Netflix and Disney Plus, these are things that will keep growing as an industry, so those stocks will grow with the other ones. The next thing we want to look at is this company growing their revenue. This will be evident in the high demand for their products or services. So if you see more solar panels going up on the roofs in the houses of your neighborhood, then this could be a clear sign that that high demand is happening right in front of your eyes. An easy way to find if a potential company is growing, you will want to head over to the income statement and mainly look at the financials that they are giving you. The income statement we won't get into depth right now, but I will show you the important things to look for. If you want to get more in depth, there is a video on my channel in my free stock market course, so you can go check that out. But for right now, we'll just go over some of the basics. The next thing you want to look at is net income. This is essentially the line on the income statement that describes their profitability. This is essentially what is going into their pockets after expenses have been paid. A company does not have to be profitable for their stock price to go up. They will have to show that they will be able to reach profitability at some point in time, because if they don't, they will not be around for long. A ratio you've probably heard of is the PE ratio. And what the number represents is how much you are paying for $1 of earnings. So if the PE is 5, you are paying $5 for $1 of earnings. If the PE is 10, you are paying $10 for $1 of earnings. So this is showing you how the company is valued based on their earnings. The number looks back on the earnings from the past 12 months. So this is a number I don't like to use for growth stocks because growth stocks revenue is very unpredictable. So it is very hard to predict what they will be doing. I like to think when it comes to investing into growth stocks, what the company will just generally be doing in the next 3 to 5 years. You will generally use the PE ratio to compare companies within the industry, but for me, I don't like to use this ratio just because I'm always creating the future story, and if I believe revenue and profitability is going to grow, that's how I use my valuation metrics. Generally, the market has a median for a PE, which could be something like 22 or 25, and this can be discovered just by Googling it. So you will see where your company is based on their valuation within the median to see if they're undervalued or overvalued. But then again, I still don't like to use this. This is just a general idea for where the whole entire market is at in the current time. Growth stocks generally tend to be overvalued anyway, so it's hard to tell how much they are overvalued. There is another ratio that represents growth, and that's called the PEG ratio, which is price to earnings to growth. And how this measurement works is 1 means that it is properly valued, anything over 1 is overvalued, and anything under 1 is undervalued. I am going to give you an example of why I don't use these ratios because they could deter you from how valuable you think the company is. So back in June 2007, Apple's PE was 34 and its PEG was 1.7. This means that the company was very overvalued, but the stock price was only $19. So when we are looking back now, they might have been overvalued, but clearly where the stock price is now, it would have been a good time to buy. Another way that these evaluation metrics can paint a foggy picture for us is the example of BlackBerry back in 2007 as well. Their PE was 55 with a PEG of 2.2. So they are way more overvalued than Apple was. And this makes sense because their share price was flying through the roof because BlackBerry was selling like hotcakes. The emotion of greed was very high around BlackBerry at the time. And if you would have let the rising stock price influence your emotions, then you possibly would have bought in to try and make some gains from watching that stock price go up. Looking back on this now, it could have been a very drastic decision for you to be buying based on the fear of missing out and not your confidence in your research and investing, because you would have seen that the iPhone was released in June 2007 while BlackBerry was making its run up. And you could have seen that Apple would have been a better investment because you would have believed in the iPhone. Now back then, this could have been a lot harder to see, but you would have known at least BlackBerry was way too overvalued for what it was, and you wouldn't have made your investment decision based on the fear of missing out. All that really matters when you're evaluating companies is the story that you're creating. And if your story has more value than the current stock price, and these are the things you want to look for when you are looking for growth companies. Another characteristic of growth stocks is you want to be looking for a new product that they could be releasing. The iPhone, for example. And you want to understand the product that is about to come out and how it is about to change the world. Because this can be a part of your story, and this is what is going to grow the revenue. You could be looking at an industry like virtual or augmented reality, and you could know a lot about that subject and see where the growth potential is going in that industry. So you will figure out what companies are laid out to have that growth ahead of them, and you'll be able to pick the winner as long as you do your research and is confident. Something most growth companies have is debt. And debt can be very dangerous for these companies if they do not continue to grow their revenue, as they will not be able to pay off that debt if they aren't able to produce that money. You can find these numbers on the balance sheet to see how much debt and cash they have, but these companies are expected to have a certain amount of debt because generally these companies are just starting out or have a long growth path ahead of them as well. So they will have to fuel that growth with debt, but you have to see that revenue increasing. Growth companies still need to have cash on hand. And this is going to be very important if we have downturns in the industry or in a recession, for example. This will also help them pay off the debt they have, which is very important because if that debt starts piling up, then they will have to excessively spend that cash so they don't go out of business. Competition is something that we are going to have to be very aware of when it comes to investing. You could be in a growing industry and there are going to be a lot of growth companies in that industry. So you will have to evaluate different companies when it comes to finally buying a stock. You could take BlackBerry, for example, as the phone used to be called the Crackberry, it was selling so much. When the iPhone was released, they eventually came into the industry and took over the market share that BlackBerry had at that time. It's weird to think that people thought the iPhone was actually going to fail. So this is why it is hard to really evaluate things, but this is when it comes to you creating your personal story and seeing how that iPhone would have developed and if they would have taken market share from BlackBerry. When it comes to math, me and Warren Buffett like to use the same equation, and that is net income divided by shareholders' equity. And what this is showing us is how management is able to use the shareholders' money that they've invested. You can find these numbers on the balance sheet and the income statement, and you will be able to determine year over year how well they are able to make a return on your investment and everyone else's investments. So I promised you a bonus at the start of the video. So we're gonna head over to my computer and I am gonna show you how you can build your watch list exponentially with growth companies. Hey guys, so the first thing we're going to start with is Tesla. And you can notice right here that they actually don't have a PE ratio. And this is because they don't have any earnings, because it's calculated with net income, and their net income is negative. Their net income is negative. So that means they can't have a PE, but they are definitely a growth company. So we'll go over and look at more P's. The trailing PE is the actual regular PE, and this is calculated on the past 12 months. And then we have the forward PE, which is calculated on the analyst expected earnings in the next 12 months. So the relationship between these two numbers is if the trailing or regular PE is higher than the forward PE, then that means they're expecting more growth. And the bigger that gap, the more earnings they're expecting. So you can see it from 277 with a gap of 25, and then it went 72, 26. So they're still expecting more earnings the next quarter. And then here you can see that the regular PE is actually lower now. So they aren't expecting much earnings coming from them. And then the current one is an even bigger gap. So they're not expecting as much earnings. You can see also here that they had no PE ratio, but they did have a forward PE. We're gonna go over to Tesla's income statement so you can see what a growth company income statement looks like. So you can see here their revenue is growing. All these numbers are in millions, so 117 million, 240 million, and they doubled that revenue. And then they did a huge jump right here. I think it's like 5 times. And then it just kept growing and growing, and then another huge jump. And then they almost doubled again. So they have been growing the revenue a lot. But just because they're growing their revenue doesn't mean they are profitable. So you can see here, look at their net income, and they're just getting in the brackets here, it's negative numbers. So they're just keeping deeper and deeper into non-profitability, and then they had a good year, but they still weren't profitable. And they got deeper and deeper, paid a little bit off, deeper, paid a lot of it off, and still paid some off. So, I mean, you want to look for these trends, but it's hard to really see where they're going because it's jumping everywhere. So now we're going to head over to their balance sheet. And what we want to look at is what do they actually have for cash and how is their cash position growing? We can see here they had 100 million in cash, 255 million, and that cash position keeps growing. Now, Just because they have cash doesn't mean that it's their money. They could be borrowing that money. There's other ways that they can get that money. So we really have to watch out for how are they getting this money. So we're going to want to go look at the debt they're taking on. So here you can see short-term debt. They've been able to definitely keep that number at steady. Like it hasn't like blown up compared to their growth, which is good, which is what we want to watch for. And then long-term debt. You can see how this is steadily increasing. So if their revenue slows down, but their long-term debt keeps growing and their cash position doesn't keep growing, then they're gonna have a hard time paying off this debt. So that's the numbers you're really gonna have to keep your eye on. And then stockholders' equity is right here. You want to see that number growing as well. And we can actually do a return on equity calculation for you guys, just like we talked about in the video. So we'll go grab net income here off the income statement. So, well, since it's negative, you can't really, because there is no return. So yeah, you can't do a return on equity for them because they're not returning anything. So that's a good characteristics of Tesla there. So now we're going to do Enphase, another growth company. So you can see how they grew the revenue. It just kept going and going up, and then they kind of stalled out a bit and actually went down. But in 2019, they doubled it. They almost doubled it. So that was a big year for them of revenue growth. But then we want to go look down at net income. So they were negative 22 million, negative 32, kept getting deeper, and then they had a good year, got almost profitable, went back in, went lower, and then boom, look at that growth from negative 12 million to positive 161 million. Like that's huge growth. That's a huge jump for the company. And then we'll go take a look at their balance sheet. So we can see on their balance sheet here what they have for cash, total cash and cash equivalents. And you can see that last year again, boom, that cash went up a bunch. But we want to see what do they have for debt. So you have your short-term debt here of 3 million. You have your long-term debt of 103 million. So if anything happened to Enphase, they would have more than enough cash to pay off that debt and still operate fine. So that's what you want to look for. Like if a company can't pay off its long-term debt with its cash, then they might end up in some trouble if nothing works out. And then you can also see here stockholders' equity. So now that we have a company with positive net income, we can do the return on equity calculation. So we'll grab the number here from the income statement, which is 161 million, and on the balance sheet we got stockholders equity is 272. So 161 divided by 272, and then we got a 60% return on equity. So they're able to use the money of the stockholders and with their profitability give a 60% return, which is really good. But you want to keep comparing that year over year. And then we'll move on to the part where we are going to grow our watch list here. One thing we want to look at is market cap. Usually growth companies are like small to mid cap companies. So here we're just going to pick small or over 300 million. And we're on a website called finviz.com. This is all free. And there's a bunch of fields in here. One of the things you want to look at is when it comes to your circle of competence, these sectors and industries will be something that is for you on things you know about. So I'm going to leave those blank, and then when you come here, you can actually fill these in. But over here in price, we definitely want something over $5. We don't want anything in the $1 range. Those are small companies and they carry a lot more risk. And then we're going to click on this fundamental tab. And then I talked about the PEG ratio in the movie. And this is comparing its earnings to its relative growth rate. So you can see here over 3, and 1 means properly valued, 2 is overvalued, 3 is highly overvalued. So, and you can go under 1 as well. But right now we're going to keep it under 2. We don't want anything that's crazy overvalued. So you can see I got 580 results of companies that are expecting growth. And you can kind of just go through these and you can narrow it down. You could go back to the sectors and industries. Like you could go, we'll say technology, and then we'll be given a whole, we have 57 companies in the technology that are expecting growth. Of course, this isn't all of them. You're gonna have to play around with this stuff and figure out what it is, but it'll give you a good idea on how to really build your watch list when it's targeted directly at you and the things you know about. So if you wanna just play around with this and see what you guys can come up with and just add companies to your watch list, and you can just go with it from there. I hope you enjoyed this video. Thanks for coming out, and I'll see you in the next one.